Welcome to RANsquawk's EU morning briefing for Monday the 10th of August of 2009. Just taking a bit of a recap of the weekend and overnight news ahead of 9 o'clock now in London. Firstly, in Asia, a piece from the Chinese Premier Wen Jiabao, who said that no plan to halt Chinese easy credit policy, according to AP Newswire. China's top economic official then cautioning on Sunday that the country still face economic problems and assured jittery investors that easy credit policies aimed at kickstarting recovery would continue for the time being. Elsewhere of note as well, in the FT, China's central bank has told heads of the largest state-controlled institutions to slow the pace of new lending, according to people familiar with the matter. That's after new loan volume in the first half tripled against last year's period. Elsewhere in the US Treasury Secretary Geithner formally requested that Congress raise the $12.1 trillion statutory debt limit on Friday, saying it could be breached as early as mid-October. And elsewhere, the front page of the Wall Street Journal this morning runs the headline, "A debt burden to limit gains in US stocks." Despite an uptick in consumer saving, debt levels have only barely begun to come down. Even after the recession ends, economists expect the gradual reduction of the nation's massive consumer debt to take years. In the meantime, they are warning that economic growth surge expected for the second half of this year could be followed by slower growth and a softer stock market in 2010. On the geopolitical front, North Korea, they've signalled it wants to improve relations with the US, has been told it must return to nuclear disarmament talks, according to a US national security official. And taking a look in terms of commodities, WTI crude futures pretty much flat this morning, without around $71 at the moment. A couple of OPEC related officials, oil prices are not bad at current levels for OPEC, that was according to the president, again signalling that OPEC is very much unlikely to cut output at its forthcoming meeting in September. And elsewhere, a senior Kuwaiti oil official says compliance by Gulf OPEC members with the cartel's production cuts has been over 90%. One of the key stories this morning has been continued focus on the UK markets. A lot of pessimism in the UK press following the extension of the QE programme that we saw last week. Being summed up, and most attention to the Telegraph this morning, the title, "UK risks a Japan-style lost decade, the Bank of England will warn," with expectations now to the quarterly inflation report we'll see later in the week. Britain has not yet shaken off the risk of slumping a Japan-style lost decade, and they'll indicate it downgrades its growth forecast and casts deflation as a significant threat, wrote the Telegraph. And also importantly from the Sunday Times, they said the Bank of England this week will downgrade its growth forecast for the year, pushing it even further below the Chancellor Darling's prediction of a 3.5% contraction, and predict that inflation will remain low for the next 2 to 3 years. The paper wrote that the Bank of England will repeat its view that the economy is close to bottoming out, but will also warn of a subdued recovery constrained by continued weakness of bank lending. Officials also saying when it comes to tightening policies, rates are likely to be raised before assets purchased under the QE are sold back to the markets. So at the moment, the UK markets have been notable movers and outperforming somewhat in terms of fixed income, with gilt futures already up around 40 ticks, and also with cable coming under a bit of pressure this morning, down 40 at around 166.50. Looking in terms of equity news, at the moment across the FTSE, CAC and DAX, we've opened a little lower and we're down around 0.5% at the moment, coming up to 9 o'clock. Two in particular stories in the UK worth noting. One for Lloyds Banking Group, company weighing up plans for a multi-billion-pound share issue to cut its dependency on the taxpayer, wrote the Sunday Times. The move comes after Chief Executive Eric Daniels said he believes the £16 billion fees for the government's asset protection scheme are seen as too much. If the government agrees to the move, Lloyds would instead shore up its balance sheet by raising substantial sums of new shares, estimated to be in the range of 10 to 15 billion sterling if it pulled out of the scheme altogether. Their shares down around 3% in Lloyds Banking Group at the moment. And also for Friends Provident, on the flip side, a lot of ongoing merger speculation with Resolution. The company, though, this morning in a note confirmed a revised Resolution proposal has been received. The company says that proposal has been sufficiently improved to justifying entering into further discussion. Friends Provident up around 4% in early trade. Again, with the stocks down around 0.5%, FTSE, CAC and DAX, basic materials are the underperforming sector at the moment. Looking ahead then, today is extremely quiet in terms of economic releases. The only thing we're eyeing now is at 9:30 for the Sentex Investor Confidence number for August out of the Eurozone. Other than that, no major data from the US. We'll be eyeing then reverse auctions out of both the Bank of England, resuming their purchases today of March 2025 to June 2032. That'll be at 2:45 to 3 o'clock London time results. That'll be followed by 4 o'clock for a Fed outright Treasury coupon purchase of 2012 to 2013 durations.